Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these Monday market updates, coming to you a day late because of the market closure yesterday on the holiday, but still some great ideas, some great information for you this week, especially on a trend that we've been watching since March and has only gained momentum. This investing trend could be one of the biggest over the next couple of years, and besides that short-term focus on this and the near-term growth, it's also got some great long-term fundamentals. So a great investing strategy we're going to talk about for the short-term traders out there as well as the longer-term investors. I'm going to jump right into that topic, but stick around for our market update after that, where we'll talk about the stocks I'm watching this week, the news that could come out this week to really drive the market, and how to look at some of those trends and strategies, as well as the sectors in the stock market. I want to jump right into that topic today, though, around food insecurity and how to invest in this. Like I said, we've been following this since March, really been writing a lot of these stocks up, but I wanted to detail which stocks I'm watching and how to invest in this trend. That Ukraine invasion, along with some bad weather in a lot of the major crop producing areas, it's really sent commodity prices through the roof, right? The UN Food Price Index, something we'll look at later, is up over 30% in the last year and up over 60% just since 2020, right? So in the last 2 years, food prices, that food price index has gone up 60% around the world, really causing a lot of insecurity, instability, and actually riots in a lot of parts of the country or parts of the world. All right, you've got Asia, Middle East, and Latin America. We've seen riots and food insecurity, as well as export restrictions. Right, a lot of countries clamping down on the exports of their commodities, saying no, we need to keep this for ourselves, and that's only causing these disparities, these price disparities that some companies are able to take advantage of. And I want to detail and point out which ones are those to you. If you do want to see the stocks, I do want to give a shout out to a report I created with the Motley Fool. It's the 5 stocks that I am investing in no matter what, right? These are my long-term buy and hold forever stocks. I'm going to put a link to that free report down in the description below. Please click through, check that out. It's in conjunction with the Motley Fool. Yeah, they're going to send you some emails, ask if you want to sign up for the portfolio advisor. I use the service. I like the service, some of their suggestions in the past, but it is totally free, no obligation to get that report and see which stocks are really some of the largest in my own portfolio, those forever stocks that I'm holding. So click through, sign up for that free report, get that by email, and you'll be supporting the channel, so I appreciate that. But I want to get into that topic because, again, we've been watching this since March. The momentum has only been building on that. We're looking here at the United Nations Food Price Index. And you can just see, just over the last couple of years, it has jumped significantly, up 60% just since 2020. And what a lot of people don't realize is, if you rewind all the way back to 2011, when we had that Arab Spring movement, a lot of unrest, a lot of riots, and a lot of regime changes around the world. A lot of people thought that was, social media clampdowns by regimes, things like that. And it wasn't. It was all about food. Okay, if you look back here in 2011, 2010, 2011, you see another big jump here. Food prices were up about 23% in the year that really ignited those Arab Spring movements and the riots. Well, now we're seeing the same thing. We're seeing 60% up in food prices over the last 2 years, really sparking these riots. And what we've actually seen is export restrictions that are causing a lot of price disparities. Countries are coming out and saying, you know what, we are protecting our own crops, our own domestic production. We're not going to allow you to export these. And that's really creating, besides those price disparities, a lot of opportunities, especially for companies in the US, Europe, even Australia, that are unlikely to face those same export restrictions. They can shop around for the higher prices, export their own production to those countries with the higher prices, or keep it for the domestic use. So the price of wheat is up 50% on the year, and a lot of these grains, soybeans, palm oil, a lot of the other grains and commodities are up just as much on the Ukraine invasion, as well as export curbs in India. Now that, alongside with some of these other grains, is really producing a windfall for the agricultural traders like Archer Daniels Midland and Bunge Limited. And we can look at those two stocks, Archer Daniels Midland here, ticker ADM, and then Bunge Limited, ticker BG. These are agricultural traders, right? So they buy from the producers. They have contracts with crop producers to buy their crops, and then sell in other markets, sell internationally to different export markets, which makes them just perfectly set up for this kind of situation. They have those contracts to buy. They also have futures contracts and other hedging instruments to buy these crops. And then they can find whichever market they want to sell those in, whichever one has the highest price. And again, because a lot of those export restrictions in different countries, those are causing price disparities that we don't always see in commodities. Usually commodities, they are so fungible and they are so easily traded across barriers and across countries, then the price is basically the same wherever you go. But with these export restrictions, they're causing those higher prices in some areas that this Archer Daniels Midland and Bunge Limited can take advantage of. So definitely ones to look at here, this ADM and ticker BG. Another set of companies you want to look at is the fertilizer producers, right? And while fertilizer prices have come down recently, those crop science companies like here, the Mosaic Company, ticker MOS, Nutrien, ticker NTR, and then CF Industries, ticker CF, are going to do well. Obviously, with a lot of these stocks, if commodity prices do come down, if we do get a resolution to the Ukraine conflict, some of these prices are going to come down. But again, why I like this trend, why I like this idea or this strategy is because it is also a long-term trend. Okay, we are constantly needing those higher crop yields, right? We are seeing year over year arable land or land available for agriculture is decreasing, and that only means that we need higher crop yields. We need to get more out of the land that we are able to use for agriculture, and how you get that is through higher use of fertilizers, right? So with that increasing food demand over the years, we're just going to need more and more fertilizers. And so that long-term growth is making these companies a great investment, great long-term investments. Here we've got the Mosaic Company, ticker MOS, again, Nutrien, ticker NTR, and CF Industries, ticker CF. We also want to look at the food distribution companies, and this might be counterintuitive. You would think food inflation going up, anyone that has to distribute food and then resell it might be in trouble. But what we see with a lot of these food distribution companies, and I'm thinking specifically of things like U.S. Food Holdings here, ticker USFD, and then United Natural Foods, ticker UNFI. These distributors, they buy from a lot of the package producers, and then they sell to enterprise clients for their cafeterias. They sell to other cafeterias, other end users, right? Now, the reason why they're holding up pretty well is because they have contracts, long-term contracts, that allow them to pass on most of their increased costs to their customers. So these food distribution companies, they are paying higher prices for the food that they buy from the packagers, but they're in their contracts, they're able to pass on those increased costs to their customers, right? So they very much have an arbitrage situation there, and they're holding up fairly well. You can see U.S. Food Holdings Corp. Down slightly so far this year, but still outperforming the broader market because they have those contracts. I want to talk about the relative losers here too, because obviously it's very important to understand not only how this trend affects some of the companies that are benefiting from it, but which ones you want to avoid. And of course, that's going to be these major users of wheat and other grain commodities. Here we've got Krispy Kreme, ticker DNUT, excuse me. And then of course, Flowers Foods, ticker FLO. Any of these packaged food companies really with an emphasis on baked goods and bread, right? So obviously Krispy Kreme donuts, you're gonna need a lot of flour for those donuts, and what do you use to make flour? Those grains, right? Flowers Foods is mostly a baked goods and bakery company. So again, really that emphasis on baked goods and breads. Not necessarily all packaged food companies, but just the ones with that oversized need to buy those wheats and other grain commodities. Now, again, I think it's important to point out here that a lot of these stocks that we're highlighting here have already gone up on this trend, especially since we've been following it since March. The ag traders and fertilizer companies in particular have seen their stocks go very high, are already trading relatively expensively on those valuation metrics. So further upside really depends on this continued instability in global agricultural prices. These markets, as we've said, a lot of these countries setting export restrictions that is creating these disparities. I think that does continue for at least most of this year, and still gives you some kind of momentum play in this. Now, why I like this so much, though, is because it doesn't necessarily all depend on that either. We could get a resolution to the Ukraine conflict. We could get a lot of these export curbs coming off. And of course, that's going to bring down prices and bring down some of these stocks. But that long-term strategy in this is still very much alive. Okay, like I said, food demand is only increasing. Arable land or land able to be used in agriculture is only decreasing. So of course we're going to need to continue to use more fertilizer. Just that general need, growing need in food demand is creating a market for these agricultural traders, because this kind of food insecurity and instability is something that we're seeing crop up at least every 10 years and sometimes more often. So I think especially these two plays, the agricultural traders as well as the fertilizer companies, are something you're going to see really boom higher at least every few years on these kinds of geopolitical warnings or risks, as well as just that general rise in food demand. Now I want to turn this over to the weekly market update that we always do Mondays 9 a.m. Eastern, so be sure to smash that subscribe button so you don't miss out on those. All three indexes bounced off oversold territory last week, up more than 6% on all three of them. So a huge relief rally there. Really took support from the Fed, coming out a little less hawkish than people had expected. And then Friday's inflation data, that PCE report, personal consumption expenditures, that the Federal Reserve really watches on that, really seemed to confirm that prices, that inflation peaked in March. That's something that we saw with the CPI, with the Consumer Price Index earlier in the month, and it was really confirmed by that PCE inflation report. Now I want to look at how the sectors did last week, really getting that big picture on the 11 sectors of the economy and how the stocks in each one of those did last week to give us that those big picture ideas. Here we are on the sectorspider.com website. Love this sector tracker tool. Lets you see how each of the 11 sectors as well as the S&P 500 did over the last week, and you can see all 11 of the stock sectors posted gains last week with really surprising strength, even on the safety sectors like utilities and healthcare, which normally you would expect these safety sectors, right? Utilities, healthcare, consumer staples, to sell off as investors shift back into risky stocks. But really the breadth of that rebound, the fact that all 11 sectors really rose strongly, is a really good sign that the entire market was just oversold and investors may be turning more positive in general. Now, even after last week's rebound, though, we can see stocks in the consumer sectors, consumer discretionary sector. We'll go here to the year to date. Consumer discretionary is still down almost 25%, right? Really one of the worst performing sectors so far. And while the market is worried about that higher inflation is going to weigh on consumer spending, household finances are still very strong. A lot of the economic data we've seen, data from the banks as far as credit card spending as well as deposits, all very good. A historically good jobs market should keep consumer spending and sentiment elevated, right? So we've heard warnings from shifting consumer spending habits from some of the retailers last week and a couple of weeks ago, from Walmart, from Target, Costco, and things like that. But we've really yet to see any real evidence of weakness in the consumer. So, with that confirmation of lower inflation over the next few months, so that I think we're going to get, and a continued strong jobs number, I think you stick with some of these stocks in the consumer discretionary sector, because obviously the worst performing sector here, that's going to have the most to gain if we do get that market rebound. Now, there is relatively little in the way of economic data or earnings this week. We've got a couple of stragglers for first quarter earnings. As far as stocks, we'll talk about what stocks I'm watching in that this week. But really, relatively little, especially until Friday, about any kind of economic news or anything to really drive the markets. And that means investor sentiment is going to have to be the one factor that holds this market up. And I think that's important, and because we rarely get a test of any one factor in isolation on the market, right? Generally, there's economic news coming out, there's Fed members talking, there's all kinds of things that are affecting the market each week, and it's really hard to tie down, what investor sentiment is or what the effect on the market of any one particular source is. But without all that noise in the market this week, we really do get to see if investor sentiment can support stocks for another week of gains. So I think that's important. One, if the market can continue to keep going up, if stocks can find some support and keep going up, then that's going to be a real a real good sign that investor sentiment is there. It's continued to turn more positive, and I think it can support stocks for weeks to come. If investor sentiment does fall apart, though, if in the absence of any other news or earnings or anything like that, if investor sentiment is negative and cannot support stocks, then it might not matter what we get as far as lower inflation data, economics, anything else. If investor sentiment cannot support stocks, then that's going to be the market's going to continue to fall over the next few months. We do get the monthly jobs report coming out on Friday. It's a holiday shortened weekend, so just Tuesday through Friday. Friday, though, economists are expecting 325,000 jobs to be net created in the United States. That would be down from 428,000 jobs last month, and actually is a very easily beatable number. I think over the last couple of months we have seen new jobs creation beat estimates, and I think this month is going to be no different. So I think we do see an upwards revision on maybe previous months' jobs revisions or jobs creation, as well as over 325,000 jobs expected that have created in May, reported here in June. Again, I think with the market shifting towards a greater fear of recession, then I think that good jobs number might actually go back to being good for the markets, right? Over the past few months, we've actually seen where a good jobs number was bad for the markets. Stock prices fell on those jobs reports numbers because it meant that if the economy is good, if the jobs picture is good, then the Fed can raise rates aggressively, right? The Fed doesn't have to worry about hurting the jobs market. If it's so strong, it can raise rates as fast as it wants and as far as it wants to really fight that inflation. So that's why we've seen these stronger jobs numbers really ding stocks when they came out. Now, though, I think a lot of investors are worried about a recession, worried about the Fed increasing rates too fast and really bringing the economy down. So I think a stronger jobs report gives kind of a confirmation that that's not going to happen, that we're not going to see a recession, at least not until next year. So I think, again, if we do get a strong jobs report, that puts a little bit more support under stocks for that. I want to look at a few of the stocks I'm watching this week. Again, very limited as far as stock earnings, but some very important companies. Salesforce.com, ticker CRM, reports its second quarter numbers on Tuesday following a big dip in the first quarter. And really, likely a lot of the same warnings that we've heard from a lot of other stocks. Earnings are expected to be about 94 cents a share over the quarter, down 22% from the same quarter last year. And full year sales growth could be just at 20%, maybe even lower, for really the slowest pace in the company's history. So we are seeing a significant slowdown here. Still, the public sector part of the business is picking up, and the company is building a software empire that spans everything from cloud to marketing, human resources, AI, productivity. Really, it's got an amazing breadth and scale to its business. Shares are down 47% over the last year, and are trading at just 6.1 times on that price to sales basis. Really the lowest I've ever seen them. This is actually one of the stocks in that free report. If you click through on the link I leave in the description to that free report, enter your email address in there when you get there, and I'll send you that free report. No obligation to sign up for anything else. And this is actually one of the largest stocks in my portfolio, one of those long-term forever stocks that I'm holding. I think it's a great company that's really got a lot of advantages, especially in AI, in cloud, and marketing. So really check that out. Check out the rest of the stocks in that portfolio. ChargePoint, the electric vehicle charger company, also reports earnings Tuesday after a really strong rebound last week, though the shares are still down 45% over the last 12 months. So again, a lot of those electric vehicle stocks have fallen over the last year. Earnings are expected at a loss of 19 cents a share. That would be about the same as last year's quarter, so kind of flat on the earnings there, on $75.7 million in revenue. Now, full year revenue is expected up 95% for this company to $471 million, though earnings are expected lower to a loss of 74 cents per share against against just last year's loss of about 61 cents a share. So really interesting dynamic here. Revenue growing, almost doubling from last year, but they're losing more money. And this is what we've seen from a lot of companies. Those, especially wage pressures, a lot of those other costs are really going through the roof, destroying the productivity or the operating efficiency for these companies. And so they're actually reporting higher growth, higher sales growth, but lower earnings and even bigger losses. Now, that recently signed electric vehicle infrastructure funding could mean some good news on the horizon, but really the downside risk here is that management lowers its outlook like pretty much every other company this quarter. So I would be worried about this one going into the earnings there. Asana, ticker ASAN, reports its earnings on Thursday. The remote work software company is down 84% from the November peak. Really one of those pandemic darlings that really rocketed up and then has since crashed down 84% since last November. Earnings are expected at a loss of 36 cents a share, again, down further from a loss of 21 cents a share in the same quarter last year. So another company that, while they may be making higher sales, is losing more money. While expected full year sales of $530 million would be growth of 40%, the company is expected to widen that loss to $1.28 a share this year. So that's quite a bit over the 92 cents loss per share loss they registered last year. So again, strong 40% sales growth, but they are losing even more money. Even after the recent sell-off, shares are still pretty expensive here at 8.2 times on a price to sales basis. And again, here, like we've seen with most of these other pandemic darlings, the work from home stocks, the software stocks, a lot of these, any warning by management and a lowered outlook for the rest of the year could send this stock down further even. Next here, CrowdStrike Holdings, ticker CRWD, also going to be reporting its earnings on Thursday, with cybersecurity firms actually one of the few groups to strike a positive tone in the quarter. Palo Alto Networks, ticker PANW, actually reported sales up 29% in its quarter on really continued prioritization among enterprise clients to that digital security, and it actually raised its full year outlook. The problem we've been seeing with most companies this quarter is they've been beating their earnings and sales expectations, but they've been lowering those full year outlooks. They've been warning and lowering the expectations on the full year outlook, and that's really been destroying stocks, but not here. Zscaler, ticker ZS, also raised its current quarter outlook after reporting sales growth of 63% in the first quarter. Now, CrowdStrike, for its part, is expected to report earnings of 23 cents a share. That's more than double last year's 10 cents per share figure. Full year earnings are expected higher by 64% on sales growth of 48%. Which implies cost pressures are not detracting from that profitability. Okay, this is kind of the reverse of what we saw in some of those other companies. Sales growth 48%, they're expected to leverage that into 64% earnings growth, right? So obviously some of the cost pressures aren't expected to hit these cybersecurity firms quite as bad. Now, even on that slower growth, the entire industry is very expensive here. CrowdStrike is trading for 16.2 times on a price to sales basis. Slower growth, Palo Alto is also 9.2 times on a price to sales ratio. So, we have had some good news out of the other companies in this space. I would still be a little worried though if CrowdStrike does come out and lower that full year earnings expectations. They are expected again to report 48% sales growth and 64% earnings growth. That would be a fairly high bar to meet. If they do come out and try to lower those expectations a little bit, that's going to hit this stock. So I think I would be maybe waiting till after the earnings report to get in on these that are good trending stocks. Don't forget, click on the video link in the description below to get your free copy of that report, the largest holdings in my own stock portfolio, or click on the video to the right for the 7 safety stocks I'm watching just in case stock prices do keep falling.